Good afternoon. This is Dale Snyder with the Snyder Group with Keller Realty here in Las Vegas. Today's topic of discussion is going to be going over the tax implications for investors wanting to short sale property. First, I'd like to say that there's been a dramatic change in what the banks are willing to do. The banks are willing to short sale investor properties. They weren't a few years ago. You know, the biggest exposure you have right now is expecting to have to pay up to 10% of the deficiency as an investor. I'm not going to get into that too in depth right now. Feel free to reach out to me if you'd like to have a conversation on that topic specifically. But most importantly, what we want to go over today is CPA related questions, because we do have a certified public accountant here today with a very good pulse on the legal ramifications in short sales with investors. So, Michael Johnson.
Hey, Dale. How's it going?
Yeah, good to see you. Thanks for coming by.
Yeah, no problem.
All right, awesome. So, Michael, let's just start off by saying, you know, we've got an investor that, you know, he only has one loan on the properties. Say he bought, you know, 2, 3, 4, 5, 10 properties, doesn't really matter, but he put 20% down, so he has one loan. Mm-hmm. Does he have tax exposure? I mean, maybe give me two scenarios. Start with somebody that maybe bought the home, say in the 80s, and they made money on it for a while, then they refied, and then they ended up losing money, you know, over the last several years, turning it into a short sale. Let's maybe start with that scenario, and then start with somebody that maybe bought during the boom days. So they really weren't cash positive at all. They were pretty much negative monthly.
Okay.
So you can kind of run through those two scenarios?
The first scenario where you bought it in the 80s, the property's probably started to be depreciated and actually might fully be depreciated by the time they're short selling now. So if they pulled money out of it, all the amount of debt that's forgiven might be taxable, depending on, it's called the basis in the property, what the, after depreciation, after the deductions over the years, what the value, the basis of the property is. So say that, you know, you purchased a home for $300,000 and over 25 years you've expensed a portion of that. Now it's only on the books per se, it's only worth $30,000, and you also have a loan on it of $100,000. Now you do your short sale and that $100,000 is forgiven. Now the value for tax purposes is only $25,000. So you're going to have a $75,000 gain on that property.
Okay.
Does that make sense?
Yeah, kind of. I mean, obviously, Michael's information's on our website. We'll put the link at the end of the video, and his information will be there as well. You know, reach out to him. He can explain it better. But I guess my question would be then, just in layman's terms, so in that scenario, there would be some potential tax exposure.
There could be, potentially, correct,
okay.
Yes.
Okay.
But more than likely, if they bought it during the boom, they paid, say, $500,000 for it. It's worth $200,000 now. They might, given depreciation and thing, which would only be a few years now, they might actually have a loss on the property, quite a big loss, because you would the whole property value would be the loss, and then they would pick up income for the 1099 they'd receive. Yes. So the amount of debt that was forgiven would be income. So they generally will offset, or it can actually be a loss there.
Okay, okay. So let me clarify. I don't know if I said this at the start of the video, but you're going to get a 1099, you know, in the short sale. And you do have this exposure through foreclosure or the short sale. So, you know, this is something that you're going to have to deal with. You know, you don't want to bury your head in the sand. You want to look out for your options and talk to a CPA in regards to this. So, if it's a property they bought at the peak of the market, using the scenario you said where they only maybe had it for 2 or 3 years, it almost sounded like they might be able to get money back on their taxes.
Correct. That's
really?
Correct, yes.
Interesting. I never knew that.
Definitely.
Okay. Well, you know, you're obviously going to want to talk to Michael about this in greater detail. You know, we've done, I don't know, 60, 70 short sales in the last few years, and the biggest pitfall or thing that comes up towards the end that we found is our clients don't seek out and understand the tax ramifications early on. So if you're just considering doing a short sale, or if you're just planning on walking away from the home, which we don't suggest, obviously, talk to a CPA. Michael's available to give you a consultation because you're going to have exposure that can come back to bite you down the road, right?
Correct. And I'm available, like you said, during, before, after. I prefer during and before. That way, you can sleep at night when I answer those questions. So
Yeah, exactly.
go ahead and give me a call, and Dale, my information will be on Dale's website.
Okay, awesome. Thank you for
All
your
right,
time.
Dan.
Appreciate it.
All right.
All right. Hope this information was valuable. Once again, it's Dale Snyder with the Snyder Group here at Keller Williams in Las Vegas, going over the tax implications for investors looking at short selling their properties.